there, this is Leslie Stokes, writer and geologist with the Northern Miner, and I'm here with Mining Clips in downtown Vancouver covering the Metal Writers Conference. And we've got Daniel Major, he's CEO of GoviEx Uranium, and which is basically a company who I believe is probably in the lead of having a producing uranium asset in Niger, Africa. And we were just talking a little bit off, and you were saying how GoviEx was actually founded by Robert Friedland's son.
That's correct.
That's right.
It was founded in 2007 by Govind Friedland. He saw an opportunity in Niger where the licenses were available between the source and the Areva mines. Those Areva mines produce about 8% of the world's uranium. He was living in China at the time and coughing while he was running around the park and realized that nuclear energy was going to be the next big thing and saw this as a great opportunity right in one of the largest uranium basins in the world. So we acquired those. By 2010, the company had drilled 450,000 meters, put a £100 million resource into play. At that point, it decided to de-risk them, and I joined the company in 2012. We've gone through 3 PFSs. We got our environmental sign-off 6 months after we applied for it.
Wow,
6 months.
That's really
Not
fast.
16 years or whatever. 6 months. We got our mine permit issued 6 months after we applied for it. So it's a fully permitted project. 120 million pounds, $25 cash cost, $360 million capital, ready to go with the market. We're working on getting that going.
Right.
So we're working on the debt, we're working on the offtake, so that when the price actually moves, we're the guys who can build into that price going forward.
So who do you have backing the project right now? You said it's $360 million to put it in production.
Yeah.
So how are you positioning yourself financially as a company to get this off the ground?
I mean,
underground?
Both. It's an open pit and an underground.
Yeah, right.
We start with the open pit and then go to the underground. For backers of the company, we have an interesting group first, but we have Denison Mines, because we acquired their mines in Africa last year. They're 20% shareholder. We then have Govind and Toshiba Corporation, who own Westinghouse. And I think you'll see Westinghouse come out of their troubles a lot stronger than they went into it. I think my analogy there for is the US car industry when it went Chapter 11. Came out a lot stronger and is now one of the strongest industries out there. We've got Cameco and we have Ivanhoe Industries as well. So we've got a very interesting and strong shareholder group. What we have done is realize that, it's a uranium project in Africa, you've got to be planning ahead. So we've already started working on the debt side. Now project debt at the moment is very difficult to find no matter what commodity you're looking for and no matter what jurisdiction. So we've taken a very strong position on this and working with sovereign governments to put the insurances in that we need. So I've got a number of banks working in our data room to put together, which is what is going to be a $220 million debt position of that 360. We're already working with the off-takers, and the team that we're using both on the offtake and the debt is the same Societe Generale team, the same SocGen team that did the Paladin debt structuring and offtake agreements. They did Mantra and Huseb before they were both taken out when they were doing their debt. So we've got one of the few debt teams that's actually done anything in uranium in the last 10 years. So that part of it, the equity side will really come later when we can show where we are on the debt on the offtake, because it's a lot easier to position your equity when you can show the full package to somebody.
And then I know a lot of these companies rely heavily, obviously, on the uranium price, which is extremely volatile.
Yes.
So what are your forecasts there? What do you predict? I know it's kind of like a magic 8-ball, and no one's ever really too sure, but of course the world is changing.
Yeah.
And everyone's looking to diversify their energy base, so I guess the question is when. But what are your feelings right now as a company?
Let's break that up into bits. I think if you look at most people's forecasts for the demand side, they're very, very similar. Whether you're looking at UxC, TradeTech, BP, Exxon, any of these guys, the range is pretty tight where they're going. It's driven by Chinese reactor builds, Indian reactor builds, Japan's steady restarts because they are coming on.
Right.
We've got 5 up and going, 2 more have been approved to start, 12 are in the permitting stage. Probably 30 will ultimately get going between now and 2020. The US and Europe have become pretty agnostic rather than slightly negative they were before. I think this is really becoming a supply side issue now from now on. Over the next 10 years, 20% of the world production shuts. Just old mines that just will finish their positions. You're seeing production cuts coming through already. You've got very illiquid market out there. I think your trigger is going to be somebody coming into the market looking for real material that they can't find. You've got this issue where the contracts are unwinding very quickly going forward as well. Nobody can afford to take on contracts at today's price because they actually can't replace their resources. So you're going to come with a stalemate between the big contractors like your Cameco's and the off-takers, and Cameco's going to say, I need that price, otherwise I shut production. And if they shut production, the price goes up anyway. So you're that close, in my view, and I'd be watching for a trigger probably this year still, where we're hearing that the various utilities are walking around trying to find material because they're okay kind of today, but as you go out each year, they're getting much more nervous about where material is going to come from. And I think there's that. And the other side I find is that some of the research you see assumes all of these projects can be built. The more work we do on it, it becomes very clear that and what we're hearing from the really top-notch off-takers is they fully understand that you cannot get projects built fast enough, and you can't put enough of them in place, and you need much higher prices to do it. So this is becoming a supply-side trigger. I wouldn't be surprised if, before the end of this year, you've seen that trigger hit in. And when it does hit in, it will be very rapid.
So what kind of price, right now I know that uranium is sitting at around $19 a pound.
Yeah.
So what's the running price on uranium that we're going to start expecting people to move pretty quickly?
I think the last time the price ran was like $28. I think if we see another run up and it breaks 30, then that's it. That will be the real break point that you've seen it go past. It will get some momentum and go, because then the utilities they've been playing a pretty sensible game, which is they've been watching, and their watching has been working for them because the price hasn't done anything and they benefited. Their concern is going to be if the price starts to run and there's a reason for it, they don't want to get left out. So they will start coming into the market and the thing will feed itself. Once that happens, then you'll have a lot more strength coming from the offtake side, the term contract market as well, doing exactly the same thing.
Cool. So how I kind of gauge all this now is that GoviEx Uranium is definitely one of those companies that you're fully permitted. When things change in the uranium prices, things are going to change very quickly, and a lot of your competitors might not necessarily have that permitting process in place. And considering it's a uranium mine, permitting might be a little bit challenging. So I guess that puts you guys in a really advantageous
absolutely.
position.
And I think from an investment point of view, the thing I kind of point out to people is if you look at the last cycle and you track the shares from 205 to 207, most of the stocks, whether they were a developer or a producer, actually followed each other. You could have bought any of them. But two of them outperformed everything else. One of them was Energy Fuels at the time because they actually built a mine. They went from being a developer to being a producer. And the other one was Paladin, which did exactly the same thing. Those two stood out from the crowd. So, if you're looking at an investment, we're arguing that look for the companies that can go from being a developer to being a producer during the cycle. Because ultimately that's what we're all about, is mining material out of the ground, not just finding it.
Yeah. Well, thanks so much, Daniel.
That's a pleasure.
It was great talking to you as always, and look forward to seeing you again the next show.
Certainly, absolutely. Okay. Cheers.